Is C a potential buy now? We're using the Select 6 analysis to look at the most telling financial metrics before estimating a fair value for C Limited, stock ticker SE. Then we're giving a rating to the business. Before we get into these valuable metrics, let's understand C's stock performance. Year to date, C's been trailing the market. They're down 27%, while the S&P 500 is up nearly 20%. Right now, C trades for $38.52 per share. Since the company went public just under 6 years ago, it's a totally different story. C's compounding at just under 18% annually. C was a pandemic darling. Since then, its stock price has really come down to earth. Even with a massive decline of more than 90% from their all-time highs in October of 2021, C is still beating the market in these last 6 years. C trades just a few dollars above their 52-week low. The company's down nearly $50 from their 52-week high. There's some short interest in the business, with around 3% of shares sold short. Even with their massive decline, C's still a big business. They have a $22 billion market cap. But the burning question is, why should we be paying close attention to C? C operates Southeast Asia's largest e-commerce company in terms of gross merchandise value and number of transactions, Shopee. C started as a gaming business, Garena, but in 2015 expanded into e-commerce, which is now the main growth driver. Shopee is a hybrid C2C and B2C marketplace platform operating in 8 core markets. Indonesia accounts for 35% of gross merchandise volume, with the rest split mainly among Taiwan, Vietnam, Thailand, Malaysia, and the Philippines. For Garena, Free Fire was the most downloaded game in January of 2022. It accounted for 74% of gaming revenue in 2021. C's third business, C Money, provides mostly credit lending. C was incorporated in 2009 and it's headquartered in Singapore. Now let's look at their numbers. Starting with metric number 1, we want C's average return on capital in the last 5 years to be above 14%. The average business earns a 7% return on capital. Looking for a benchmark that's double this can build in margin of safety based on the quality of the business. Over the long run, over the course of decades, a stock's likely to return what its underlying business returns. These business returns are captured by return on capital. In this time, C's had negative returns on capital in all 5 years. This is partly due to where the company's at in their business life cycle. Their returns on capital were negative in all 5 fiscal years, but they were progressively less negative. C may be starting to round a corner, as in their last 12 months they actually had positive returns on capital. The company posted positive operating earnings for the first time in their history. Still, because we're looking for consistency, we're looking at their average here. This is an X on metric number 1. Metric number 2, we're looking for growth. C's seen a lot of growth in these last 5 years. We want their revenues, net incomes, and free cash flows to have grown in this time. All 3 need to be up for this to be a check. We'll also include their last 12 months worth of numbers, which aren't shown on this chart. In this time, C's revenues are up huge. They've grown by 15 times. The company's seen massive growth. Their net incomes, which were negative in all 5 of these fiscal years, are actually positive today. Similar story with their free cash flows. They posted 1 year of positive free cash flows in 2020, and they've had positive cash flows in their last 12 months. With huge growth and now positive net incomes or earnings and their free cash flows, this again points to C potentially rounding a corner here. All 3 of these are up. This is a check on metric number 2. Metric number 3, we're looking for earnings per share growth in the last 5 years. We learned their net incomes or their earnings have gone from being negative in all 5 fiscal years to positive in their last 12 months. We still want to look at what the company has done in terms of their shares outstanding, even though there's no amount of shareholder dilution that can cause them to have lower earnings per share now that their earnings are positive. In this time, C's diluted shareholders by 71%. That's huge shareholder dilution. They've been pretty steady diluting shareholders in all 5 of these years as well. It wasn't just a one-time affair for the company. In September of 2021, C raised $7.2 billion of equity in convertible bond sales, which was Southeast Asia's largest fundraising. At this time, this caused more shareholder dilution. They used that cash for investments and potential acquisitions. Worth noting, in 2023, C disbanded its investment division after disappointing returns, including the failure of FTX. Also in 2020, C became the owner of Singapore's Premier League football club, Lion City Sailors. They've diluted shareholders at multiple times. This is something you definitely want to watch out for. However, because their earnings are now positive, this is technically a check here on metric number 3, but keep that caveat in mind. Metric number 4, we want to see free cash flow per share growth. A very similar story here. C's free cash flows are now positive. They were only positive in this time in 2020. Because they've gone from negative to positive, this outpaces any shareholder dilution the company may have done. This is a check on metric number 4. So far, through our first 4 metrics, to recap, we have 3 checks and only 1 X for C. In recessions, it's businesses with a lot of debt that can have the biggest losses and even go bankrupt. Metric number 5, we want C's net debt, which is their total debt minus their cash and their short-term investments, to be below the sum of their free cash flows in their last 5 fiscal years. In the last 4 years, C has had negative net debt. This means they have cash left over after paying off their debts. Right now, they've been using up some of this cash and they have around $1.1 billion in cash left over after paying their debt. At the same time, in the last 5 years, even though they're cash flow positive today, C's consumed $3.2 billion of cash in their business. That's more than their net debt position supports, although again, things may be rounding the corner for C as a business. Keep in mind the company did take a big $1.1 billion hit because they had a sizable change in their unearned revenues. That's something to dig into. There seems to be a lot of moving parts to C, especially with the company's investment arms souring in recent years. This is an X on metric number 5. Now let's get into our valuations. The big metric of them all, metric number 6, we want C's average 5-year free cash flow divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 different ways we're estimating a fair value for C. Right now, C has around a $21 billion enterprise value. This accounts for both their market cap and their net debt position. It looks at C similar to it being a private company. In this time, we learned they consumed cash in their business in the last 5 years. This means that they've had a negative average free cash flow to enterprise value yield. On a current basis, in the last 12 months, C produced $300 million of free cash flow. When that's divided by their $21 billion enterprise value, we get around a 1.5% current free cash flow to enterprise value yield. That's well below the yield from the 10-year treasury, meaning it's down from our risk premium as well. Keep in mind, because of where the company's at in their growth stages, they may be rounding a corner here to more sustained profitability, especially as both their earnings and their free cash flows are now positive. That previously wasn't the case in their history. Even still, these yields are coming in below what we're looking for. On metric number 6, this is an X. Don't just throw the business out. We need to estimate their fair value per share and talk about our rating. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze C, which takes us on to using a discounted cash flow model to estimate their fair value per share. A DCF model is based on the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. C has a short track record as a public business. They've also been growing insanely fast. This makes this estimate very rough for the company, especially compared to some other businesses we're looking at. We're starting with their current free cash flows and using assumptions for how they've grown since being publicly listed in order to project these into the future. It's up to you to figure out if these are accurate or not for C. Assuming they grow their free cash flows at 5% annually for the next decade, then in the following decade, assuming that these grow at 4% annually, we're adding in their tangible book value to give an estimate of their net worth. If we want a 15% rate of return, which is what Warren Buffett looks for from his investments, from today's valuation multiples, if these are the same 20 years into the future, a rough estimate of C's fair value is around $31 per share. That's down just $7 below their current stock price. It's slightly below their 52-week low. Please be mindful, this analysis is not financial advice. This paints a very broad stroke for C, and it's up to you to dig into the company to learn more. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. In just a minute, we'll talk about our rating for C, but let's address something first. We've covered their numbers, but the qualitative factors of C's business are even more important. Why don't we figure out what they are? Starting with the factors supporting a long thesis. Number 1, C could maintain its leading market share as Southeast Asia e-commerce expands without having to sacrifice profitability through increased sales and marketing spending. Number 2, Garena could find another hit game that increases bookings in addition to Free Fire. Also, India could rescind its sanctions on Free Fire. Number 3, the lack of financing options for the underbanked could propel C as a leader for lending in Southeast Asia. But it wouldn't be fair if we didn't cover the negatives of their business as well. Looking at the factors supporting a short thesis, number 1, C might be challenged to maintain profitability due to its low switching costs and lack of differentiation on its platform. Number 2, Free Fire is already 6 years old and appears to be experiencing a secular decline in users. Number 3, if C money is limited to the Shopee platform, consumers could opt to use other regional payment platforms amidst ample competition. In about the last year, C's laid off more than 7,500 employees, which has been more than 10% of their workforce. That's something else to keep in mind. There you have it for a balanced perspective of some of the qualitative factors of C's business. Now let's talk about our rating. We learned through analyzing C, stock ticker SE, that this Southeast Asian e-commerce company may be rounding a corner for its business. They've gotten to GAAP profitability and they're generating positive free cash flows after growing like a weed for the last half decade. The big hit to the company is they've massively diluted shareholders throughout this high growth journey. And retail, even on the internet, is likely to be a very competitive space both now and into the future. C does have a $1.1 billion cash cushion, and they're now cash flow positive. Still, those yields didn't look attractive compared to the yield of the 10-year treasury. Again, this is not financial advice. When we performed a discounted cash flow analysis of C, based on today's valuation multiples, if those are the same 20 years into the future, if you want a 15% rate of return and you believe those assumptions, an estimate for C's fair value is around $31 per share. That's just slightly below where the company's traded at in their last 52 weeks. They were last at those levels in November of 2019 before they went on this monster stretch as a pandemic darling. When we look at all the factors of our analysis, C looks like a strong candidate for further research. Dig in and learn more about the company if you're interested. Thanks so much for learning about C with me. If you enjoyed the video, subscribe to the channel for more and check out this next one.